Someone usually tells you that renting is throwing money away, but current mortgage rates have disconnected home ownership from that old logic. With mortgage rates sitting above 6.5%, the math of home ownership looks completely different today than it did in 2021. At today's prices, a home purchase functions as a high-stakes leveraged investment with a multi-year lead time before you see a return. If you buy a property and life forces you to move before a very specific timeline, that house can actually drain your net worth. Your financial outcome depends on your personal time horizon, regardless of any social milestones or outside pressure to own. To figure out how the math applies to you, you have to identify exactly what kind of housing consumer you actually are. First, there's the lifestyle renter. This person values moving between cities, keeping their cash liquid in the stock market, and refusing to spend their weekends fixing a leaky roof. Then you have the legacy buyer. This is someone planning to stay in the exact same location for a decade or more, focusing on building stability and passing down equity. Most of us are in a third category, the in-between household. We want stability, but aren't sure we'll stay past 5 years. For this group, guessing isn't enough. You must know the exact year the financial scale tips from renting to buying. Identifying which of these 3 paths matches your reality is the required first step before you sign a lease or a mortgage. Let's break down the first half of the equation, the upfront cash needed to reach the closing table. This chart shows exactly what happens at closing. A buyer dropping down a 20% down payment is coughing up roughly $79,000 upfront. A huge chunk of that goes straight to transaction costs and loan fees, meaning you instantly lose about $3,000. Meanwhile, the renter only puts down about $6,000 for a deposit and first month's rent. The reason buyers take that initial hit is leverage. You might only put 20% down, but you earn appreciation on 100% of the property's total value. But renting has its own powerful financial advantage, driven by opportunity cost. If the renter takes that same $79,000 they would have spent on a down payment and closing costs and puts it into a conservative account yielding a 6% return, their wealth compounds immediately. They pay no broker fees, they handle 0 roof repairs, and their cash remains entirely accessible. If the growth of a buyer's home equity cannot outrun the renter's steady investment returns, the upfront cost of buying leaves the homeowner trailing behind. Next, we have to look at the month-to-month reality of holding the property. A typical buyer today locks in a 30-year fixed mortgage around 6.5%. On top of that payment, you must budget 1% of the home's value every single year for maintenance, plus another 1.5% for property taxes and insurance. These high carrying costs provide 2 major benefits. Your fixed mortgage acts as a shield against future rent inflation, and a portion of your payment acts as forced savings, reducing your loan balance every month. This graph compares the total accounting and opportunity costs of buying versus renting. Look at the 6.5% mortgage scenario on the right. Because the interest rate is so high, the share of your early monthly payments going toward principal is painfully small. It takes exactly 4.7 years for the buyer's financial advantage to cross the renter's curve. If life forces that buyer to sell before that 4.7-year mark, they haven't made a dent in their principal debt. They paid a higher monthly premium than a renter and walked away with very little to show for it. Because early equity builds so slowly at current rates, a strict commitment to time is the only factor that ensures the monthly math of homeownership works in your favor. The final piece of the equation is how the government treats your housing profit. The IRS has a very specific rule under Section 121. To secure the tax benefits of home ownership, you must live in the property as your primary residence for at least 24 months out of a 5-year period. Once you cross that 2-year threshold, the financial reward is massive. You can exclude up to $250,000 of pure profit from federal capital gains taxes if you are single, or $500,000 if you're married. The flip side is severe. Barring specific health or job relocation exceptions, selling before you hit that 2-year mark means you owe taxes on your profit. If you sell a property after owning it for less than a year, the IRS taxes your gain at the short-term capital gains rate. That is identical to your ordinary income tax bracket. Surrendering up to 37% of your housing profit directly to the IRS wipes out the financial leverage you were trying to gain by buying a home in the first place. Real estate functions as a highly effective wealth builder, but only if you successfully hold the asset long enough to cross the specific time barriers that shield you from taxes. Combining upfront fees, interest, and taxes reveals a timeline. In years 0 to 4, lifestyle renters win. In years 5 to 9, in-between households reach safety as tax exclusions activate and savings outpace transaction costs. Past year 10, legacy buyers thrive with massive tax-free payouts. Pinpointing exactly where you land on this timeline determines whether a house acts as a financial windfall or a liquidity trap. Ultimately, if your horizon is short, rent an apartment and invest the difference. If your horizon is long, buy a property and hold on to it. The math shifted when rates doubled, making the break-even point significantly harder to reach than it was during the 3% interest rate era. And for those choosing to buy, crossing that 4.7-year break-even point requires financial discipline to actually save that 1% annually for maintenance before the roof leaks. It is time to drop the social pressure that insists renting makes you a financial failure. Renting is a highly effective tool for preserving capital and maintaining mobility. Ultimately, the best financial decisions are mathematically matched to your realistic life timeline and not driven by emotion.